from the University of Maryland. And so many of you know Pete's various contributions to finance theory. He worked on a variety of topics, among them market structure. And he has been doing extremely interesting empirical work with Anna Obijayeva the last couple of years. So I'm going to present the new state of this project. Thank you.
Okay, well, thank you very much for asking me to come lecture at the Isaac Newton Institute here in Cambridge. I need to apologize for the fact that the paper I'm about to present does not actually have all that much mathematics in it, but it's the paper that is most related to systemic risk of all the papers that I've been working on recently. The title of this paper is Large Bets and Stock Market Crashes. And I think maybe this is what we saw in the stock market last week, is perhaps some large bets being either liquidated or placed, and that created some temporary instability in stock prices. And what I want to study in this paper is essentially some case studies of how very large bets that were executed in past stock market crash events can be analyzed from the perspective of a research project that Anna Obijayeva and I have been working on that we call Market Microstructure and Variance. So instead of presenting this paper slide by slide, what I'm going to do is skip to slide number 25. And essentially, the whole paper can be captured by this slide. So if you're about to fall asleep from all the lectures today, focus on this one. So what you're looking at is a graph, and on the horizontal axis of this graph is, you can think of it as the log of dollar volume in the markets for different securities, either the market for individual stocks, which is the blue dots, or the market, the aggregate stock market as a whole, which you could think of almost as being the futures market today for stocks. And those are the 5 red dots. Okay, and my co-author Anna Obijayeva has a data set, and let me just say that the range of dollar volume that you see in markets varies quite a bit. So if you go to the far left of the horizontal axis, the exponent is -12. That'd be e to the -12. And if you go to the far right-hand side of the graph, the exponent is 8. But forgetting about what the actual number means, that horizontal axis is varying by a factor of e to the 20th power as you go from one side to the other, which is approximately 2 to the 30th power, which is possibly approximately a billion. So, so on the left-hand side, those dots represent markets where the trading activity is 1 billion times less than the dots that you would hypothetically see if you went all the way to the right side of the graph, but you actually don't get quite there. But you still get to e to the 20th power. And so now let me tell you about the vertical axis. Before telling you about the vertical axis, let me tell you that my co-author has a data set of portfolio transition trades, which we think of as representative, and this is kind of an identifying assumption, but representative institutional size transactions executed in the markets for individual stocks in the U.S. And the trades have kind of a distribution of trade size. Now we're going to call them, sometimes they use the term trade and order and bet in an inconsistent manner, but we're going to think of a portfolio transition order as what it is in a database. Portfolio transition occurs when one institutional asset manager is being replaced by another one, and someone has to go in and replace the old portfolio of the legacy manager with the new portfolio of the new manager. And the difference between the two portfolios we're thinking of as a bunch of bets in individual stocks, because these portfolios tend to be portfolios of stocks that might hold a couple of hundred stocks. Okay, and so what we're interested in is examining the sizes of these portfolio transition orders. Now, if you were to look at data on, say, the ticker tape or the so-called TAC data in the U.S. of actual trades that you see in the market, a portfolio transition order might be executed over a 3 or 4 day period, and it might show up as hundreds of different trades reported on the ticker tape. So it's essentially what some other people would call a meta order that might be shredded into various small pieces for execution. And what we're talking about here is the meta order. So this is what they intended to trade. So if you think the vertical axis is the logarithm of the sizes of these portfolio transition orders as a fraction of the the average daily volume in the stocks the month beforehand. And as you can see, what the blue points are, we have the data set has 400,000 orders in it. And the blue points are kind of the points that you would use if you were going to do a quantile regression at the 99.9th percentile. So these are approximately the largest 1/10 of 1% or even a smaller slice of the data that started out as 400,000 transactions. And what I'm going to tell you later when I go back and show you some other slides is that if you look at the size of these points for a given vertical slice, you'll find that the distribution of the order size is very much like a log normal distribution. So when I tell you I'm graphing the log of the size as a fraction of average daily volume, it'll look like a normal distribution. And so what we want to do is we want to basically in this paper we want to do three things. We want to first look at the data that I'm showing you now, and second we want to construct a kind of very simple theory of why these data look the way they do, and then third we want to relate these data to stock market crashes. And what you see when you look at this picture is that the cloud of blue points seem to lie on a downward sloping line. Okay, and what does that downward sloping line say? That downward sloping line says that the big bets, if you will, or the big portfolio transition orders in the small stocks, which are the ones over here to the left, are much larger as a fraction of average daily volume than the big portfolio transition orders in the large stocks, which are the ones over here to the right. Okay. And so what I want to do is I want to discuss that fact in the light of our theory of market microstructure and variance. That's a theory that we've developed that kind of is designed in part to explain why this should occur in data. So now let me tell you what the lines mean. So the theory of market microstructure and variance, and I'm going to tell you about, predicts that these blue points should lie on a slope on a straight line that has a slope of minus 2/3. Okay, and so the red line represents the mean portfolio transition order, which since we're looking at the 99.9th percentile, we wouldn't expect to see points lying here. So the ones over here on the left, I'll talk about in a minute. And it has a slope of minus 2/3, which is the slope predicted from the theory. The first green line you see would be portfolio transition orders that are one standard deviation above the mean, meaning not one standard deviation of the log normal, but one standard deviation of the underlying normal distribution. So that it turns out that these portfolio transition orders have a gigantic standard deviation, which we think is what you see in data. I've looked at some other data, and you see it in other data as well, which we think is typical of orders that are placed by institutional asset managers. Some of these orders are gigantic because you'll have an asset manager who picks individual stocks and holds a pretty concentrated portfolio, so they'll buy just a huge quantity. Other orders that portfolio managers make are very small. If you have a quantitative investment strategy, you might be trading 100 stocks or 200 stocks simultaneously, and you might place a bunch of small orders in a bunch of different stocks. An index trade might be a smaller orders in individual stocks. I'll talk about that some more in a minute too. At any rate, the portfolio transition orders have a gigantic standard deviation, so that a one standard deviation increase in a portfolio transition order when you turn it into a log normal turns out to be a factor of about 5. So each standard deviation represents orders becoming 5 times bigger. So the green line, the first green line you see, would represent one standard deviation events, meaning orders one standard deviation above the mean. The next green line is 2 standard deviations above the mean. The next green line is 3 standard deviations above the mean. And as you can see, many of these blue points are sitting between 2 and 3 standard deviations above the mean, which is consistent with them being kind of in the 99% plus size category. And then you see some of them even more than 3 standard deviations above the mean. And those are the truly gigantic orders. And then finally, if you look at the fourth green line, you'll see about 5 points that lie beyond the fourth green line. They would be the 4 standard deviation and greater events. And since there are 400,000 data points that we're looking at, the question is whether 4 or 5 4 standard deviation events is what you'd expect to see. And I think the answer is it's not unreasonable to see that, but that maybe you wouldn't expect to see quite that many points. So there may be a little bit of a fat tail in this distribution. Now, the points on the very far left, as you can see, don't seem, the points on the right seem to pretty much lie on a green line that has a slope of minus 2/3. The cloud of blue points that you see on the left seem to be kind of too small for lying on that line, but those are also trades in like almost penny stocks that are very small trades. You know, so some of the trades might be for $2 or for $100 or $1,000. They're economically meaningless in the context of the entire stock market. I just put them up there to show you that the data ranges over a factor of 1 billion. So you can ignore those, and you can think of the main cloud of points, which is the rightmost half or the rightmost 70% of those blue points, as being not only the S&P 500, which includes the vast majority of the market capitalization in the U.S., but it also includes many of the other stocks as well. And those that you see to the left are companies that are near bankruptcy, about to be delisted, and not very important companies. Okay, so the good thing that we wanted to point out with this picture is that these blue points do seem to lie on a line that has a slope of about minus 2/3, which is to say that orders in relatively smaller stocks that are less actively traded tend to be larger as a fraction of average daily volume. Indeed, if you're looking at the origin here, you actually see some trades in the northwestern quadrant. Those are trades in stocks that are kind of on the smaller part of the distribution, but that are for more than 100% of the average daily volume in the stock. You see very few such points in the northeastern quadrant, but you see a handful of points in the northeastern quadrant, which are trades in medium-sized companies that are for more than 100% of the average daily volume the previous month in that stock. So I want to do 3 things in this paper. I want to explain why we expect the slope to be 2/3, minus 2/3. I want to talk about the theory that gives you that prediction. Then I want to relate it to this cloud of points. And then finally, which is the systemic part of this paper, is I want to talk about the 5 red dots. So the paper is really about the 5 red dots. And what are the 5 red dots? The 5 red dots are 5 stock market crashes. And if you're looking at this picture, you can see that 3 of them lie on the 6 standard deviation event line. So theoretically, if we're thinking about a normal distribution, 6 standard deviation event is something we should never observe in a normal distribution. So theoretically, we shouldn't be seeing points like this at all. On the other hand, we think that in our portfolio transitions data, we may have underestimated the standard deviation. Among other reasons, just one type of trade. And you can think of, there are many different types of trades in the market, and even though portfolio transitions might be typical in the sense of having the right mean, if they're different types with different means, when you put them all together into a mixture of distributions, the standard deviation will increase. So maybe our standard deviation is maybe too small. So these 6 standard deviation events that you see there, we think in reality, once we get our model better calibrated, might be 5 standard deviation events. So then the question is, would you ever expect to see a 5 standard deviation event in a normal distribution? And the answer is, if you have billions of observations, you would. And indeed, what you're going to have here, or is enough millions of observations is what I should have said, you would. And what it turns out to be the case is that you do have millions of bets taking place over many decades, and so you would expect to see a handful of 5 standard deviation events, although not 6. So what are the 3 dots? First of the 3 dots is the 1929 stock market crash that I wanted to talk about. The second of the 3 dots is the 1987 stock market crash. And the third of the 3 dots is the 2008 stock market crash that didn't register on the radar screen of most people, but I think was one of the most interesting events to occur in the financial crisis, and that was the liquidation of the rogue trades that Jerome Kerviel had made at Societe Generale. And he was making these trades in 2007 and early 2008, and he was discovered in January of 2008, and Societe Generale came into the market, liquidated all of his positions over a 3-day period, and that's something that we're going to call a stock market crash. But what you're not looking at here is not the price effect of his trading, you're looking at the size of the position that was liquidated. His positions were truly gigantic, something like 50 billion euros. And it would be sort of the way we had calibrated it as a 6 standard deviation event. that we really shouldn't be looking at, but that's what it is. And then we have two other red dots that are on the a little bit above the 4 standard deviation line. One of those is the flash crash of May 2010, and the second one is another flash crash that occurred in 1987, 3 days after the main stock market crash, which was Monday, October 19th, 1987. But on Thursday, October 22nd, 1987, 3 days later, George Soros made some fairly gigantic trades in the futures market and triggered a flash crash as well. So those are the 5 points. And so what's the punchline of this paper? One of the punchline of this paper that maybe I will use a laser pointer to make this point is that if you, or maybe, oops, what did I do? Yeah, here it is. If you look at these large stock market crash events, and you simply move horizontally, you will bump into this blue cloud of points, right? And these gigantic transactions represent trades of something like 25 to 50 to more than 100% of average daily volume in the stocks themselves, or in the case of these red dots, they represent trades of 100,000. You got it? We want to magnify it more? Yeah. Oh, we want to put the control L back on. Yeah, okay. You'll see that if you move back into the cloud of points by moving horizontally at approximately the 100% of average daily volume level, you'll eventually bump into the cloud. And if you even if you move from the 2008 Societe Generale trade, you bump into the cloud. And this is, in our opinion, given many market participants and many commentators about markets and people that have propaganda that they want to share about the markets, has created a false impression of what happens in markets. So what the practitioners of the stock market crashes have said, this namely Societe Generale and the people that did the portfolio insurance, they've said, well, it's fairly common to see trades of 25% of average daily volume stretched out over 4 days, or trades of a third of average daily volume stretched out over 3 days. These are things that occur all the time, and they're not all that disruptive. They may create, a noticeable market impact, but they're not really disruptive. And therefore, we, meaning let's say the people liquidating Jerome Creviel's trades, or alternatively the people that were engaging in portfolio insurance during the 1987 stock market crash, they would say our trades are not going to be very disruptive either, because there are these fairly gigantic trades that you do see in data. When you look at institutional trades, you can see them here in this cloud of points representing the largest 0.1% of trades. And we want to argue that that interpretation is just completely wrong, because what you should be doing is not moving horizontally along the axis representing 100% of trades to compare apples with apples, but instead what you should be doing is moving with a slope of minus 2/3 up on this green line. And when you move up along this green line, you're basically in outer space, which is to say that you're looking at gigantic bets, which are many times, maybe hundreds of times larger than anything you would have ever expect to see in an individual stock. So largely our thinking is that these large bets are extremely disruptive. They're extremely disruptive to the market as a whole. And if you thought about calibrating them relative to the theory that our market, relative to the way our market microstructure and variance theory says to calibrate them, you wouldn't be moving horizontally, you'd be moving up along these diagonal lines with slopes of minus 2/3. And so we think that these stock market crashes, therefore, were crashes that were the result of the trading by the market participants themselves. And it wasn't, for example, as Societe Generale suggested in its discussion of its own liquidation of Jerome Creviel's trades, they suggested that it was unfortunate that they happened to liquidate 50 billion euros of positions over a 3-day period during which the market had fallen 10%. And we would think that, well, maybe they had something to do with the market falling 10%. Maybe the liquidation of those trades might have even made the market fall more than 10%, because, as we shall see, the Fed came into the market, cut interest rates by 75 basis points. It should have been a very bullish event around that same time. Okay, so that's the punchline of the paper. Does anybody have any questions now? I can go back to page 2 and then
So your graph only refers to volume and size of trades, but
not to the price effects.
yes, but in your discussion you refer to disruption and price impact. So
Right, so I'm gonna talk about that as I talk about market microstructure and variance, I hope. But basically, what market microstructure and variance gives us is not only a distribution of trade size, but it also gives us a distribution of market impact costs. And I'll talk about the market impact costs that it gives us. Well, and to answer your question, let me skip ahead and talk about what the predictions of our invariance theory were. There's some puzzles here. They're not perfect, but the magnitudes are right. During the 1929 stock market crash, the market actually fell like almost 50% over a period of several days. You know, it was not just excuse me, it fell 25%, and it was not just one day. The stock market crash of 1929 was kind of a 2-day period with some extra days added in, so it unfolded over several days. We predict a much bigger decline. We predict 50% decline. So to us, that says something must have been different about 1929. Either our model's wrong or something is different about 1929. And what is it that's different about 1929? And we think that what's different about 1929 is that the markets then were less integrated, and because they were less integrated, they were kind of more resilient. I'll talk about that a bit more later. If you look at the 1987 stock market crash, the market actually fell 40%. We predict, based on our invariance theory, the market should have fallen about 19 or 20%. So the market fell more than we predicted. But keep in mind, in 1987, the payments mechanism was breaking down. The actual infrastructure for the market looked like it might blow up, and so we think that some of the decline was related to not just the selling, but the fact that it strained the infrastructure so much that people were panicked about the infrastructure. In 1987, again, George Soros trades seem to have reduced prices by 22%. We predicted only 7%, so we think that perhaps his trades had more price impact than we predicted because he executed them very rapidly, and I'll talk about that a bit more later. For Societe Generale, we predicted a 12% decline. It was actually 9%, but to keep in mind that Ben Bernanke had cut interest rates by 75 basis points at the same time, we think that's a very accurate prediction that our model would have made. So if you'd come to us the weekend that they discovered that Jerome Curviel had made these trades and asked us what's going to happen when we go into the market and liquidate his positions over a 3-day period next week, we would have said the market should go down about 12% based on that's our point estimate of what should have happened. And it actually is pretty accurate since it went down 9%. Finally, there was the flash crash of 2010. Market actually went down 5%. Our theory would predict that it would have gone down only 0.5%. And again, just like the flash crash of George Soros, we think the reason it went down so little is that the trades were done extraordinarily rapidly. And if trades are done extraordinarily rapidly, the price impact they have is likely to be very temporary. And in both cases, the Soros case and the flash crash case, the price impact was indeed temporary. It was reversed completely minutes later, so that you see a big spike downward and then spikes back up. And we think that has to do with the speed of trading. As I'll talk about in a minute, conventional thinking, the idea of moving horizontally along the axis would suggest these trades would not be that disruptive, and you would get very tiny declines anywhere from 0 to 1%, which clearly seem to be, in our minds, way too small. But these are actually the theories that finance professors have put forward into the standard theories of these crash events.
So the green column is with linear impact, that's what you call
no, the red column is with linear impact. We're not using square root impact here, we're using linear impact, which I may talk about. I'm not sure if I'll talk about it. And the green column is what Merton Miller would have said and did say about the 87 stock market crash, or what Dick Roll would have said about the 87 stock market crash, or what other finance luminaries would have said about this. And I'll talk about it in a second because I've got some slides on it. Anyway, that's kind of where we're going. And so let me go back. Actually, if there are any questions, I'll answer them now. Any more questions? This is a good question to begin with. Okay, let me go back to page 2, all the way back up, and we'll kind of go through step by step. So So what we want to do in this paper is three things. We want to talk about market microstructure and variance, generating predictions about both the size of the bets, but also the price impact. This predicts both, and I showed you the graph of the size. We want to show how we calibrated this model using portfolio transitions data in a different paper on market microstructure and variance. And then we want to just entertain the idea that the entire stock market is kind of one big market. And then think about, if we think about the entire stock market as one big market and do some thinking about how to measure trading volume in the entire market, can we generate predictions about the sizes of declines that you would get from gigantic bets based on our market microstructure and variance theory. And then what we did is we went back and studied past stock market crashes to the best we were able and picked the ones where there was actually data on the quantities traded and tried to use those quantities traded to see if they were the price declines were consistent with our theory. So in general, to put this paper in perspective, there are two types of let's say, market crashes that occur. They're the types that are associated with banking crises and sovereign debt defaults, which Jean-Charles Richet was talking about essentially earlier today, or at least talking about the theory behind. And there, you typically get gigantic declines in the stock market that unfold over a period of time, but these gigantic declines, we would say, are probably due to fundamentals. And you wind up with horrible recessions that last a long time. And we would agree that they're probably due to the banking system being disrupted and not being able to provide credit to businesses, and that perpetuates a recession that lasts for a very long time. So that's your typical banking crisis, sovereign debt default scenario that was described in Reinhart and Rogoff's book. Very often these are associated with housing bubbles or big booms in housing prices and collapses in housing prices. That's not what we're talking about. We're talking about crises that originate not in the sort of the credit cycle and the way banks and banks lending practice and capital practices, but we're thinking about things that originate in the stock market. And occasionally you get crashes or panics in the stock market that typically produce very sudden, very severe declines in prices that don't unfold over a month or a year. They unfold over a day or an hour or maybe over a week. The declines are enormous, but the banking system is, in all of the five events we're looking at, the banking system is not compromised, and the economy actually looks like it might be able to recover after the stock market crashes, and this, you can debate whether they did or didn't. It didn't after 1929 in some sense, but after the other four, you could argue that it did. But sometimes they happen to be taking place in a time frame that corresponds with a banking crisis about to unfold, such as the Société Générale trades in 2008. So we're talking about these stock market crashes that are typically not associated with banking crises, but are associated with big declines in stock market, and typically very puzzling declines in stock market. So we've got, I'll skip this slide. We've got our five crashes. The three big ones that you saw as the three big dots, the 29, 87, and 2008 Société Générale. We've got the two flash crashes, or small ones, one in 1987, one in 2010. Yeah?
You don't consider the dot-com bubble?
No, we don't consider the dot-com bubble because we couldn't find evidence of one giant trader liquidating huge amounts. Now, if we had looked more carefully, we might have been able to attribute that to something related to the liquidation of positions. But the dot-com bubble also didn't collapse in like 1 or 2 or 3 days. The dot-com bubble collapsed over a period of time. So that was just a way that particular bubble unraveled. And these stock market crashes we're talking about may or may not be associated with bubbles. It just the 1987 some people thought it was a bubble when it imploded. And I assume that Bob Shiller thought it was a bubble because he's always thought, every time I've asked him, it's been a bubble. But excuse me?
Every time the market goes down, it's a bubble for him.
Yeah, but at any rate, after the 87 crash, there was not a recession and prices came back. So that was one that clearly was not a bubble, and that's two of our crashes fit into that. So our main result is that when you look at these crashes from the perspective of market microstructure and variance, if you had some information on what the sizes of the liquidations were going to be, you could have made reasonably accurate predictions about what the price pressure that is going to result from it. If you liquidate in an orderly manner, like 3 of the 5 crashes, you'll get a kind of somewhat permanent decline, meaning it'll decline and not bounce back within the next week or even a few days. It might bounce back within the next 6 months or a year, but you'll get a kind of a big decline that will be somewhat persistent. On the other hand, if you compress the liquidation into a few minutes, then you're going to get a much larger decline, but all of that decline will reverse itself, except for the part that would have been permanent if you had executed those trades in a more orderly manner. And this suggests that for these gigantic stock market bets, to make it reasonably orderly, you want to do the liquidation over at least 3 days and maybe even longer. I would guess a week or 2 weeks would have been better in some of these cases. And I'll talk about the 29 crash if I get time making that point. So at any rate, using our invariance theory, we think you could have generated reasonable predictions about the magnitude of the crash, and you can also generate reasonable predictions about what the sizes are going to come along every now and then that might lead to a crash. So let me just talk about the conventional wisdom. You might think this paper is pretty pedestrian when you give it to an audience of people who are not finance professors. It might sound not so controversial, but if you give it to an audience of finance professors, it's very controversial because you have a long tradition in finance that includes people like Merton Miller and Myron Scholes and Eugene Fama. Those are the ones that won the Nobel Prize. And then you have Leland and Rubenstein. They're the ones that actually invented portfolio insurance that I think was the cause of the 1987 crash. They all took the position that if you apply the capital asset pricing model or some model of risk aversion to the entire stock market, then liquidating, maybe 1% of all the outstanding share, 1% of the market capitalization of the stock market is kind of dumped into the market. It shouldn't have that big of a price effect. And therefore, they think something other than portfolio insurance would have caused the 1987 stock market crash. To put this into perspective, Merton Miller in 1991, writing about the 87 crash, said putting a major share of the blame on portfolio insurance for creating and overinflating a liquidity bubble in 1987 is fashionable but not easy to square with all relevant facts. And then that's just blurb. The next part is the important part. No study of price quantity responses to stock prices to date supports the notion that so large a price decrease, about 30%, would be required to absorb so modest a 1 or 2% net addition to the demand for shares. I think he meant maybe net subtraction from the demand of shares, but basically if you think of the portfolio insurers as liquidating 2% of the market capitalization of the stock market in 1987, he thinks it's unreasonable to think that a 30% price decline would have resulted. We think that that's actually a pretty reasonable number. The concept of market efficiency that we associate with Gene Fama has also been kind of used to think about this. The Brady Report, and I should say I worked as a staff member for the Brady Commission, which was the commission that studied the 1987 stock market crash. So yeah, I'm that old. To account for the contemporaneous 28% decline in price, this implies a price elasticity of 0.9 with respect to trading volume, not 0.9 with respect to the, which they think is unreasonably high. So they also think that just in an efficient market, you ought to be able to dump large quantities on the market and not have a price effect. So that's part of what I would call conventional wisdom. So microstructure invariance, and I want to talk about, disagrees with conventional wisdom. We think that dumping 1% of market capitalization on the market might make prices decline by 20 to 50%, or selling 10% of average daily volume could make prices decline by 2 or 3%. Now, you also have another theory of market crashes, and I would call that the Keynes-Shiller-Akerlof theory of animal spirits. Not a real well-developed theory, but just to kind of paraphrase or summarize what I think their theory is trying to say, it's that animal spirits, or some kind of irrational instincts, make prices fluctuate as a result of random changes in psychology, which might not be based on information, or it might not be based on rationality. So the idea there is psychology makes people do crazy things. And we disagree with that. And one of the things that makes us disagree with it, we disagree with it as it applies to these stock market crashes. It might apply to the banking crises and housing bubbles that we see, but when you think about these 5 stock market crash events, I couldn't find any psychology at work that would have led to these events actually occurring. You can take a poll of people after they've occurred and say, did the stock market crash rattle you? And the answer is yes. After the splash crash of 2010, people got really rattled. But nobody was getting rattled before it happened, and nobody even got rattled to make it happen. People got rattled because it happened. So the irrationality or animal spirits didn't cause these stock market crashes. In the 1987 crash, people were discussing whether it would occur, and there were the term market meltdown had been invented and was being discussed well before the event itself occurred, and there wasn't anything particular going on in September and October of 1987 that was any different psychologically or from the perspective of kind of animal spirits than was going on kind of in the months before that. Similarly, in 1929, it was well known that stock market values were very high, and it was well known that some people thought they were too high, but there wasn't anything particular going on right before that crash occurred, other than the fact that as the market fell, people started getting margin calls and dumping shares. And so margin calls made people dump shares, and that probably rattled some people, but what was triggering this was the margin calls, not a change in psychology. So we think this theory is kind of wrong too, as it applies to these stock market crashes. So let me talk a bit about market microstructure and variance and where this theory comes from, and then I'll talk some more about these crash events. So basically, we think that that essentially in markets, the markets for individual stocks, when you look at them, they kind of look different because there's a lot of trading volume going on in maybe an active stock like Apple, and not much happening. Some other stocks that trade a couple of times a day. But what we think is that if you view time as something that's kind of endogenously determined for each stock, so every stock has its only natural rate at which events unfold, and if you kind of change the speed with which time operates when you move from one stock to another, then all these stocks should start looking the same. If you slow down Apple and you speed up a real small stock, then you'll reach a point where the small stock and Apple kind of become indistinguishable if you didn't know what the units of time and some other units that we'll talk about were actually measured in. So for active stocks, it's a game, but it's a game played really fast, like chess being played, in a couple of minutes. For inactive stocks, it's like chess being played by mail, where it's snail mail. But it's basically the same game that's being played. It's just being played at different speeds. So to capture this idea in a very kind of informal and non-rigorous way, we say that there are traders who place orders. We call these orders bets. And the bets are decisions kind of independently made, and we think of them as statistically independent decisions to buy or sell shares, and that these decisions are made at a rate gamma, and they trigger meta orders or bets that arrive into the market at rate gamma. But then the bets might be executed kind of slowly because the traders want to hide what they're doing, so one bet might be executed over the course of days or weeks, and there may be hundreds or thousands of other bets being executed at the same time. But the bet arrival rate, we think, is kind of the time clock for that market. So in a market where bets are arriving very fast, the clock is ticking fast. If the bets are arriving very slowly, the clock is ticking very slowly, and you'll see low level of trading volume. Now, when a bet arrives, it triggers this some meta order or a bet that can be measured either in dollars or numbers of shares. So we'll call it numbers of shares, and the numbers of shares we'll kind of have a generic random variable Q to denote the number of shares. Maybe there should be a subscript here for every stock and for every bet in that stock, but we leave out the subscripts. And so we think of it as like a Poisson process, a compound Poisson process that has an arrival rate of bets gamma, and then a size of these bets that are kind of mean zero, and have a distribution that's represented by the distribution of Q. So business time, the speed is going to be what we think of as the speed with which these markets operate. Now, we think of bets. One way to measure bet size is not shares and not dollars, but you could measure bets as the size of a bet as the standard deviation of mark-to-market gains that occur on the bet per calendar day, conditional on the number of shares traded. So that would be something like multiplying the size of the bet Q by the price of the shares to turn it into dollars, PQ, and then multiplying it again by the standard deviation of returns in a calendar day. And that gives you the amount of money that you would make or lose on a mark-to-market basis on a day-by-day basis if you held that bet for a long period of time. But our basic idea, we used to call it trading game invariance. These are kind of older slides. We now just call it bet size invariance. Is that the risk that is transferred by bets is the same in the market for Apple as it is in the market for some inactive stock if you don't measure the risk that's transferred by the bet per calendar day by multiplying by the standard deviation of returns per calendar day, but instead measure the risk that's transferred by the bet by multiplying the standard deviation of returns per unit of calendar time. And the standard deviation per unit of calendar time is the daily standard deviation, which you see here as sigma, divided by the square root of the rate at which bets arrive. So that's a much smaller standard deviation. So in Apple, there might be thousands of bets per day, so that's just a few basis points. For another stock, it might be 100 bets per day, and so it'd be 1/10 of the daily standard deviation of returns. For discussion purposes, a typical stock has a daily standard deviation of returns of about 2%. P times Q might be, for an institutional trade, might be a number like $100,000 or $1 million or something like that. So what we argue is our basic invariance principle is that if you take the dollar size of the bet P times Q and multiply it by the standard deviation of returns per unit of calendar time, you'll get a random variable, and that random variable will have a distribution that's the same for all stocks. So what does that tell you? Does that tell you that the bets for Apple stock are in dollar size bigger or smaller than the bets for another stock? Well, let's suppose that Apple and the other stock have a standard deviation of 2% a day. If Apple has thousands of bets arriving per day and the other stock only has dozens, then per unit of business time, the standard deviation of returns for the Apple stock are very, very small, and for the other one are very big. So what the invariance is going to say is that the dollar size of the bets in Apple stock have to be bigger, and the dollar size of the bets in the other stocks have to be smaller.
The notation, the P
Yeah.
and the Q tilde are all what again?
The P would be the price of the stock. The Q tilde would be the number of shares in a kind of generic bet in that stock.
So it's the average trade size.
Yeah, so the average P times the mean of Q would be the average trade size.
What you call a bet is not an order, it's like a meta order.
Right, it's what we call a meta order. So if you multiply P times Q, you're getting the dollar size of a meta order kind of as a random variable. And we think in Apple, the dollar size of the meta orders or bets are going to be random variables that have a bigger mean than the dollar than in the smaller stocks, but by a factor that is proportional to the ratio of this standard deviation per unit of business time in the two stocks.
That ratio is, so the gamma is the number of bets.
Number of bets per day. Yeah. So.
But that's not observable unless you have the portfolio.
Right.
transition.
So what we're going to do is claim that we don't observe that, we don't claim, but we claim that portfolio
Observe
transition.
that. You have that data, right?
Well, we have portfolio transition data that we claim is a proxy for a bet in terms of size distribution. And we also, I've been working on another paper using Incerno data, which used to be called Abel-Noser data, which is a much bigger data set, and finding something kind of more comforting, but not exactly the same as what's in the portfolio transitions data, but something very similar. You know, maybe a 10% difference in size or standard deviation. So it's we think that our portfolio transition orders are fairly good proxies for bets, but you know, maybe they're off by 10 or 15% in terms of mean or variance.
So one might expect to see something like market cap of the firm or
Yeah. So what we
outstanding shares or something. Why is it showing up here?
That's a good question. So one of the things, part of the answer to that is empirical, and part of the answer to that is theoretical. So the empirical answer is that market cap and dollar volume per day are highly correlated. You know, because stocks tend to have kind of the same turnover rate, and if you have the same turnover rate, market cap and daily trading volume are kind of collinear. And the second thing is that we just think of this as a theory about trading. So if you have a stock that, let's say, 50% of it is tightly held by the founders and the other 50% trades regularly, and you compare that with a stock that doesn't have any founder and 100% of it trades regularly, we think of the two as not being equivalent. We think of the one that has 100% that trades regularly as having more activity and therefore probably bigger bets. It's something that we kind of look at in our invariance paper because we do some regressions that involve market cap. But we didn't really pursue it very far. It is something that could be, you know, it's something that's statistically significant, but we didn't think it was economically that significant in terms of adding extra explanatory power. But since they're so collinear, it's hard to attribute it to one rather than the other.
How do you think of this in terms of price pressure?
That's a different paper, but in our main invariance paper that I'm going to summarize in a minute, there's a theoretical model. And the theoretical model says that traders produce private information. They'll like get a signal, and then the signal generates a bet, and then they come into the market and they execute the bet. and the market knows that bets have information content. But in this particular theoretical model, the market knows that half the bets have information content and half the bets are placed by people that are like imposters pretending to have information content, or people who are overconfident who think they have information content but really don't. And so what happens is the market reacts to all bets. The market can't tell one bet from another. So the market reacts to all the bets as if 50% of, they were all 50% informative. So they don't give the full price reaction they would have given to a bet they knew to be informative. They give half that price reaction because it might not have any information in it at all. And what that does is it allows the people that have the real information to actually make money because the market doesn't react enough. And of course it allows the people that think they have information but don't have any to lose money, and the losses of those people that don't really have good signals offset the profits of the people that do, so that the market makers who are pricing this actually break even. So that's kind of the flavor of my 85 paper or Gloston Milgram's paper built into this. And then what happens is that the depth of the market responds to the number of bets that are arriving, and the number of what's given exogenously is the number of noise trades of the number of uninformative bets arriving, not the number of the dollar volume of the uninformative bets, because it's kind of based on we base it on the market cap actually. In the theoretical model we assume a constant turnover rate, and then the number of informed traders adjust endogenously. And the endogenous adjustment of the informed traders will determine the overall bet rate in the market, because the number of informed traders adjusts, but the sizes and number of the noise bets also adjust because they mimic the size of the informed trades. And then what we show is that these invariance principles that I'm going to talk about here actually fall out of a theoretical model. But to summarize, it's a theoretical model of adverse selection with linear price impact. That was what Rama was referring to in his question earlier.
Fixed turnover rate and noise rate.
Yeah, so it's a fixed turnover rate from noise traders that drives this, and we just assume that a constant fraction of the market cap, say 100% a year, just to pick a number, turns over every year, and that automatically makes the trading volume and the market cap collinear, perfectly collinear. So it kind of deals with your question by that mechanism. Any other questions? Let me go on then. So basically what's going on here is that when the number of bets arriving per day gets really large, the standard deviation of returns between bet arrival rates falls, so the size of the bets has to become bigger. And a very simple algebra, it's all the mathematics in the paper, basically exploits the fact that the standard deviation is the square root of the variance. So as the bet arrival rate is changing, it's the variance that's changing kind of exactly inversely proportional to the bet arrival rate. To convert that into a standard deviation, you have to take a square root. And that square root, taking that square root results in a kind of 2-to-1 ratio that I'm about to talk about. I'm going to skip this slide. You do a little do a little algebra, and you find that, well, we can't measure, we don't see the bet arrival rate directly. But what we do see directly is trading activity, which we define as the product of dollar volume. V is share volume, so V times P is dollar volume up here in the first line. And we take the product of that and sigma, just kind of an adjustment for leverage. And you can ignore the zeta, assume it's 2, and think of that constant here is 1 for the time being. And we know that the dollar volume then that you see in the market is going to be the number of bets that are occurring, and the number of bets, the expectation, is the rate at which they arrive, gamma, times the expected size of the bet, but now we're measuring the bet size to take into account the amount of risk transferred per calendar day. Okay? So we can observe this, because we can observe dollar volume in the market, V times P, we can observe sigma. And then a little algebra shows that the bet arrival rate has to be proportional to the 2/3 power of W if our invariance hypothesis holds, and it's because of this 2-to-1 ratio that's created by converting a variance to a standard deviation. And the number of bets has to be proportional to the 1/3 power of trading activity. And then that 1/3 power of trading activity can be multiplied by some invariant distribution, I, that we think of as the dollar mark-to-market gains or losses per unit of business time on a bet that we assume has the same distribution for all stocks. So essentially what you see in red here is the implications of our invariance theory for bet size. And all that's left to do is to kind of get some scaling constants to understand what the proportionality constant actually is. and also figure out what the distribution of I actually looks like, what kind of shape it has. And what we found in our invariance paper was that the distribution of the bet sizes actually has a log normal distribution if you ignore the sign on it. So if you just take the absolute value of the dollar, normally in finance what you do is if you're buying, you think of it as a positive number, and if you're selling, you think of it as a negative number. So if you take the absolute value, that's the size of the trade. That absolute value, which is a positive number, we found empirically has something very close to a log normal distribution, which I was referring to when I was showing you the picture earlier. So the log normal distribution is going to be characterized by two parameters, the mean and the variance of that underlying normal. And the variance, if the invariance hypothesis holds, the variance of that log normal distribution is going to be the same for all stocks. And the mean will be varying according to these equations. And essentially, what this says is that if trading activity increases by a factor of 8, then what's going to happen is the number of bets that arrive per day will increase by a factor of 4. And the size of the bets will increase by a factor of 2, the cube root of 8, and the 2/3 power of 8, respectively. Okay? So that's the basic idea of invariance. Here's a picture that explains what happens. You go from 4 bets a day to 16 bets a day. That's an increase in bets of a factor of 4. The bets are going to get twice as big. That's showing those arrows getting twice as big. And therefore, trading activity is going to increase by a factor of 8. That's the story in that picture. So that we tested this on portfolio transitions data. I'm running out of time, so I'm not going to talk too much about what portfolio transitions are, other than there are 400,000 orders in this portfolio transitions data, representing 2,680 or so different portfolio transitions. And according to this invariance hypothesis, the log of the fraction of trading of a bet as a fraction of average daily volume, if multiplied by this trading activity variable raised to the 2/3 power, that should have a distribution that's invariant across stocks. And to give you the basic point, what we did is we sorted the stocks into volume and volatility groups, so 10 volume groups and 5 volatility groups, and I'm presenting volume groups 1, 4, 7, 9, and 10 here, going horizontally, and 3 of the volatility groups, 1, 3, and 5, going vertically. The red thin line is the normal distribution that would represent the pool, the mean and the variance of the log of the bet size of the pool sample of 400,000 bets. And the shaded kind of orange or brown looking color here represents the empirical distribution of the actual sizes of the bets in those various bins. And to the naked eye, sitting from where you are, these distributions look pretty invariant. Not only do they look invariant, they look like a log normal because this is the log of the bet size compared with a normal. And that's basically, in our sense, confirming visually that this invariance hypothesis is pretty reasonable. And then what I showed you in the picture at the beginning of this lecture was, I think, it was essentially the far right tail of each of these 50 bins. I can't remember the exact number of points. It may be the largest 10 or so in each of the 50 bins. So maybe it's 500 points that I showed you. So this is our, we think that portfolio, this market microstructure invariance, at least as far as the bet size is concerned, is a pretty good theory. And we estimate that the log of the bet size had a variance of 2.5 to a standard deviation of about 1.6, but more importantly, it means that a 1 standard deviation increase in bet size is a factor of 4.85, close to the number of 5 that I was telling you about earlier. And that number implies that 50% of the trading volume is generated by the largest 5.7% of bets. And if you have linear market impact and think about how the bets contribute to price volatility and price formation, it's the variance we're talking about, and the price impact is that we're talking about is the variance of returns created by these bets, and that's proportional to the squared size of the bets. So you get a result that said that 50% of the variance of returns is generated by the largest 0.08% of the bets. So 1 out of every 1,000 or so institutional sized trades, the biggest 1 out of every 1,000 is generating half of the returns variance that you see in the market. So it's like saying the stock market is really an institutional market governed by these very large trades by the very largest traders. We calibrated this to a benchmark stock that has a $40 million daily trading volume and a 2% return standard deviation. It would have been in kind of the middle of that blue cloud somewhere. It's actually the origin. So if you looked at the origin, the log of 0 is scaled to be this stock. And the average size of a bet in this benchmark stock is about, I think it says average, I think that meant to be median, is 0.3% of expected daily volume. And the benchmark stock has about 85 bets per day. So the median bet size is about 136,000, and the average bet size is $472,000. And then if you think of order imbalances, the order imbalances on a daily basis are about 38% of volume. A 4 standard deviation event would be a $75 million order, which is 2 days, roughly 2 days volume in that stock. So now what we do in the paper here, this crash paper, is extrapolate this to the market as a whole. And that's what was going on in that picture. But to extrapolate it to the market as a whole, we need some measure of what the volume is in the market. And for the more recent periods, we took the sum of the volume in the futures market and the volume in the stocks themselves, but maybe it should have been a fraction of the stocks themselves. But essentially the volume in the futures market is as much as the volume in all the stocks themselves. So you have hundreds of billions of dollars in volume in the stock index futures market. And so what we did is we just extrapolated the sizes out and estimated what you'd expect to get in the futures market. And the answer is about 19,125 bets per day, a median bet size of about 4 million, an average bet size of about 14 million, a standard deviation of daily order imbalances of not 38%, but only 2.5%, because there's so many more bets generating a central limit theorem, that's got the square root of n that it's divided by. And a 4 standard deviation event would be a bet of about 2.2 billion, and it would not be something that would be very unusual to observe. So let me just, to put that in perspective, look at this flash crash event. The CFTC and the SEC, when they studied the flash crash, they reported that it was the largest single bet that had been made by anybody that year, that it was the largest single amount bought or sold during the course of one day by any account number during the entire year 2010 to date. And if you figure about 15,000 bets a day and about 100 days had passed and kind of do the math, 4.3 standard deviation event, that's about right. You should expect 4.3 standard deviation events to occur every now and then, maybe once every several months. So it matches the size pretty well. We also get out of our invariance theory a transactions cost formula under the assumption that the bets are generating the returns that you see in the market through linear price impact. We estimate a linear price impact parameter, and we have a formula here that basically says that if you express a bet as a fraction of average daily volume and scale it so that 1% of average daily volume is kind of your numeraire bet, and you look at the standard deviation of the returns in the stock and scale that to what we call our benchmark stock with a standard deviation of 2% per day, and you look at the dollar volume of the stock and scale that by our benchmark stock with a standard deviation of $40 million per day, then what you get is a market impact parameter lambda that represents the number of basis points of market impact you would get from trading 1% of average daily volume in that benchmark stock. And then you can use that formula to extrapolate and estimate the impact of gigantic bets in the market as a whole. And we estimated 2.89 basis points. I think in the current paper that's changed to like 2.5 basis points. But the fact of the matter is it's calibrated reasonably accurately. You can see the standard error here is 0.195. And we also estimated that, let's see, excuse me, yeah, there's an issue too about whether you multiply the lambda bar by a half or not. And if you think of a half lambda as 2.89 basis points, then lambda, the price impact of the whole thing, is 5.8 basis points. So those are the numbers we extrapolate to the market as a whole to get the results in the paper. And I see that I'm almost out of time, so let me skip ahead rather quickly. We had to deal with some other issues that I've swept under the table so far of kind of defining the boundaries of the market, and we very simplistically just added together the volume in the futures market and the cash market. The theory as of now doesn't distinguish between permanent and transitory price impact, although we're working on a new paper on smooth trading that does distinguish that. And we needed expected volume and expected volatility as inputs. That's what sigma is, kind of an expected volatility, so you kind of have to estimate those things. You need, especially in thinking about 1929, to think about changes in the market mechanisms that have occurred over the years. And there might be also in these particular 5 crash events, there theoretically could be other events that would be confounding events that would have been occurring at the same time, such as the 75 basis point interest rate cut when Societe Generale liquidated its positions. I've shown you this picture before that's based on the formula. The price impacts are based on the formula that I just showed you, extrapolated to gigantic bets in the market as a whole, and the numbers seem, we think, to be quite realistic. And so the predictions that we have are large, and they're similar in magnitude to the actual prices, but there's some differences. And in particular, we think the 2 flash crashes, where we measured the impact as the top to bottom impact, but that impact rapidly went away. And the impacts that we got the impacts you observed were far larger than what we predicted. So consistent with this other paper we're working on smooth trading, we think that trading very fast, executing a large block extremely rapidly, temporarily disrupts the market by creating a downward spike in prices followed by a rebound. And the thing that we learned that we think was new and different, wasn't something we were expecting to learn, was that the financial system in 1929 seemed to be really, really resilient. And we did a lot of reading of the newspapers and other archival materials to see what made it resilient. And one of the things that might have made it resilient, there are kind of 2 theories we have. One theory we have is that they didn't have a futures market back then. So markets were a lot less integrated. And if you think about one of the values of having a futures market in stocks, it allows you to hedge. But what does the hedging allow you to do? The hedging allows you to be more leveraged. That's exactly like Jean-Charles Rocher was talking about today. It allows you to be more leveraged. But if you become more leveraged, you essentially become more fragile. That if things go badly, it's more likely that you're going to blow up. And in 1929, they had things that resembled hedge funds that we call today. They called them trusts or syndicates or something like that. But you would set up a trust to trade one stock. So if you can imagine, in today's world, if hedge funds only traded one stock, you would need a lot of capital in the hedge fund industry, and it would be kind of resilient because something bad going on with 10 stocks would not collapse the other 1,000 hedge funds that you have operating. So we think that the lack of integration of the markets in 1929 might have made them more resilient. The other thing that was going on in 1929 was the fact that the markets were, I think, more cautious about leverage. There was a widespread expectation in the market that stocks were kind of overvalued, and also that it was known that there was a lot of margin buying going on, and it was also known that the people who were buying on margin had kind of weak hands and they might get flushed out of the market. And so the banking system in 1929, rather than deciding it was going to jump in with the investors who were leveraged and bet on the market going up and get bailed out when the market went down, instead the banking system kind of bet the other way, and the Fed was encouraging them to do that by encouraging the banking system not to engage in lending to finance speculation, and the New York banks in particular were not doing so. And then when the stock market crash actually occurred, there was a large shadow banking system in 1929 that immediately collapsed. And the shadow banking system in 29 used stock market collateral as collateral for like overnight loans. And then when the stock market prices went down, nobody wanted to lend money collateralized by stock market collateral anymore. But guess why? It wasn't because the lending was risky. These loans were very well margined. What it was that the interest rate in the stock loan market and the broker loan market, which is what they called it in those days, was extremely high. So a lot of hot money had flowed into the broker loan money to capture these really high interest rates. When the market crashed, even though it crashed like 25%, the haircuts on these loans were sufficiently large that the loans were pretty much not underwater. But what did happen is the demand for borrowing, since people had been liquidated with margin calls, the demand for borrowing dropped precipitously, and the Fed also started pumping money into the economy, and so the interest rate on these loans plummeted, and so the people withdrew their money from the lenders, withdrew their money from the broker loan market because the interest rate was too low, and they put their money into the banks, which were offering a higher interest rate on time deposits. And so the financial system didn't collapse, but instead you had a huge amount of cash flowing in the banking system. The banking system took all this cash that was flowing in and said, we'll take all these loans that are still left over onto our bank balance sheets and lend. That's what we've been waiting for. We've been kind of waiting for a collapse to occur. So the banks back in 1929 were much more prudent, and so the 1929 crash actually did not lead to brokerage firms failing. It did not lead to banks failing. It led to a lot of margin calls and a lot of unhappy people, and you read about people jumping out of windows. But it didn't, in some sense, destabilize the banking system. Another thing that happened was that the banking system took these loans and kept them on their books for like a month or two, and then allowed people to kind of liquidate their positions. You know, maybe they were a bit under margin, so those loans were kind of risky, but they allowed them to liquidate their positions a month or so later. And that kind of smoothed out the liquidation instead of compressing it into a week or so, allowed it to take place over a couple of months. So I think I'll just stop there and just say that we think this paper is practical because it does provide an early warning system. Like if you know about a Societe Generale type event, or maybe a corner in a, or not a corner, but a big speculative position in a futures market that's going to be unloaded, we think you can generate reasonable predictions about what the price effects of this will be. So I had an hour, right?
I had a question.
Yeah.
Variance principle. Do you think it's robust to the increase in the high frequency trading?
Oh, okay. So one of the slides I skipped talked about what we call the volume multiplier.
Mm-hmm.
Okay, and we think that when a bet hits the market and is executed, somebody takes the other side of the bet. And what I simplistically assume for the purposes of today is that there's like a New York Stock Exchange style specialist that's on the other side of the bets. And even though the compound Poisson assumption assumes the bets are independent, we think that in reality there's like some negative autocorrelation. So the specialist inventory would maybe go to zero, you know, in some limiting sense. But that would suggest that for every buy there's like a specialist on the other side, and that's why that zeta over 2 that I showed you on a slide earlier I kind of skipped over. The reason it's divided by 2 is there's a specialist on the other side. But what I think is more realistic assumption is there's more intermediation than that. First of all, the specialists are gone, and you've got different kinds of brokers. Like in a standard dealer market, I'll buy from one dealer, Phil will sell to another dealer, then the two dealers trade with each other, and so now we have like more intermediation going on. So it is possible, and some people would argue that it's probable, that that high frequency trading, that's a kind of a 21st century phenomenon, has increased the amount of intermediation that goes on in the market. You know, that they do these very short-term trades, and that kind of artificially magnifies trading volume. I don't buy the argument that they increase volatility, and I don't buy the argument that they're in any sense destabilizing. And if you look at the amount of risk-bearing they do, it's kind of known that it's close to zero. So I don't think that they're an important part of the price formation process, except in the second-by-second basis. And what they do is they kind of help make prices follow a martingale on a second-by-second basis. And furthermore, this hypothesis that they magnify the amount of intermediation, I'm very questioning of that too, because the high-frequency traders tend to be about 30%, like in the stock index futures market, they tend to be about 30% of the buying and 30% of the selling. But if you go back to the old days where you saw all those human beings with the colored jackets screaming and yelling in the pits, well, they did. Many of those individuals were brokers, but also many of them were independent floor traders trading with their own money for their own account. You know, they would call themselves market makers or scalpers, depending on among themselves they call themselves scalpers, but when they're talking to the press they call themselves market makers. But they were about 30% of the volume too. So my theory of this is that the high-frequency traders have just put those human beings out of business, but that would suggest they haven't really increased the amount of intermediation that's going on by very much, maybe by a little bit, but if they've increased it, it's not by very much. On the other hand, I think that there's behind what your question is a very interesting point, which is that the amount of intermediation volume, this factor, maybe is bigger than 2. Maybe it's 3 or 4, something like that. And studying what it is an interesting topic for research. Yeah, Rama.
In your talk, you talked again about volume and size of bets, but then in the conclusions you always referred to price change and market disruption, but you had a slide where you mentioned that from the volume alone you cannot deduce anything about price impact because that depends on how large a time scale, how much time you take to unravel that, to unwind that position.
Okay.
So I'm not quite sure what that descaling relation imply about price change.
This is a fantastic question, but to answer it requires going into a different research agenda. So this invariance paper that I was describing, it thinks about the time scale with which bets arrive, and it thinks that the bets are going to be executed in some normal amount of time that represents some kind of trade-off between how much information they have and their desire to get the trade done, based on maybe other people eventually collecting the same information. So we think that if the rate at which bets arrive in a market increases by a factor of 8 or a factor of 4, that's a good factor to use, then we think that bets will be executed kind of 4 times faster on average. That's our current thinking. And by the way, if you extrapolate that, if you look at the Anserno data, for example, or look at the portfolio transitions, the market participants have...
Yeah, but sorry, that already means you think of orderly execution.
Yeah.
But the red points on your graph...
let's look at those red points again.
Flash crash is probably not an example.
Right. So the flash crash and the Soros crash, they were the smaller in terms of quantity, but they're on our radar screen because they had pretty big price effects.
Because they were not orderly, right?
They were not orderly.
Very quickly.
Yeah, they were not orderly, and the fact that they were not orderly shows up as, in the flash crash, the market was going down, and then it plummeted 5%, and then 10 minutes later it came back up 5%, and then kept fluctuating. So, whereas after the 1987 crash, the market was going down, and then it crashed in 87, but then it kind of stayed at a low level for quite a while, and only gradually, after over a period of months, came back.
They're very different.
So they're very different, and we think that this sudden plunge followed by a very rapid reversal is a hallmark of trading too fast. And so let me tell you how to calibrate that. So if you think about the bet arrival rate as governing the kind of being proportional to the natural speed, if you look at portfolio transitions, the big ones are done over several days typically. The very biggest ones in our data sample were done over a couple of weeks. And think of the big ones being done over like a week. So what that means is that if you want to trade, a week is not that big a deal for the more actively traded stocks where things are happening very fast, but a week is not that much time for the stocks in the bottom of the S&P 500, let's say, or the ones that aren't quite in the S&P 500. So we think that in the portfolio transitions, the execution of the portfolio transition orders in those smaller stocks was a little bit hurried, but not that hurried. We think that the market, the portfolio transition managers and their customers negotiate a time frame that is designed to kind of minimize losses resulting from transactions costs, so they're not going to be giving away too much by doing things in too disorderly a manner. So we think that, say, 5 days for a kind of illiquid stock, which would be one of the ones, up here, 5 days might be pretty reasonable. But let's extrapolate from 5 days down here, where the log is -2, up to the market as a whole, where the log is +8. So now it's e to the 10th power. What's that? Can you do that in your head? But it's like 25,000 or something. And you need to take the 2/3 power of that to convert it into how many more bets there are. But when you do that conversion, you get that things are happening a lot faster. And so what would correspond to executing something over 5 days or a month in a relatively small stock, when you extrapolate it into the market and apply it, we did the math and apply it to something like the flash crash, what you get is that you could do an order of the size of the flash crash, which was $4 billion. You can do that in a day. You might even do it in a half a day, but you wouldn't want to do it in 10 minutes. And this other paper that we're working on says that if you
for the flash crash,
yeah,
actually, if you look at, there's a study by Albert Menkveld. He
yeah.
got the order flow of the people, the Kansas fund who actually sent that order. And what's very what's very interesting in his paper is that he shows that the price dropped before most of their trades got executed. So they actually sent the orders to the
right.
market.
Right, and
they were actually executed after the price fell. So this tells that it's not about trade so much; it's about orders, because already putting the orders in the order book sends signals to the algorithm.
Okay, so this is exactly the topic of this other paper that Anna Vajayev and I have on smooth trading. And what we argue, and we actually apply it to the flash crash, and what we argue in that paper is that if the flash crash, the $4 billion bet, had been executed over a half a day or several hours, prices probably would have fallen, instead of fallen 5%, they might have fallen 50 basis points and then kind of stayed there, sort of consistent with what happened, okay? But instead, we think that that order was executed maybe 10 times faster than it should have been. And the result is that there's 10 times more instantaneous price impact than there should have been, but the order gets executed really, really fast. So pretty soon they're not selling anymore, and then the price rebounds. And what we show in that paper is that if traders try to minimize their price impact, they will tend to slow down their trading and trade very gradually. They'll have like what we call smooth order flow. And the price will be a function, if you're a trader, the price is going to be a function of two things from your perspective. It's going to be a function of your inventory and the derivative of your inventory. So if you start selling kind of fast, that is kind of like the derivative of your inventory getting large, there will be price impact associated with that. And so what our model predicts is that in a flash crash scenario where you try to liquidate $4 billion 10 times too fast, that's 10 times faster than the equilibrium would tell you in our model to liquidate, the price immediately plummets 5%. And then you do all your selling as the price is rising, because the market senses, maybe you think of it as the market sees that your limit order showing up in the limit order book, but the market senses that someone is trading rather aggressively, because if you're selling 100 contracts a second or something like that, which might be about how fast they did it, that means somebody's buying 100 contracts a second, probably a high frequency trader, and they sense that the derivative of somebody's inventory has changed in some enormously large manner, and so prices drop very, very fast. And then the selling actually takes place as the prices rise. So the people that argue, and Mcbelt in particular, the people that argue that it's surprising to see prices rising while the selling during the flash crash is taking place, I don't think they've worked through a general equilibrium model of trading with market power and asymmetric information that actually generates a prediction one way or another. And when you actually work through such a model, that's exactly what the prediction is. So the people that, in our opinion, caused the flash crash were the people that sold the $4 billion. I think they would like to, perhaps, I'm not sure, I'm not able to read their minds, but they might be comforted by the fact that the market fell and then they did most of their selling, and therefore they can use that as an excuse to say we didn't cause it. But that's not what our theory says. What our theory says is if you cause it, that's exactly what it's going to look like in the data. So I guess we've run over, but I'll be happy to chat outside. Thank you very much.